Joining us now to help break down what the new jobs report means for the Fed and the economy is, as it considers its rate policy, former Fed Vice Chair Roger Ferguson, also TIA's former president and CEO. And of course, we are lucky to have him as a CNBC contributor. Good morning, Roger.
Good morning.
Nice to have you on right after this number. I know we'd all like a little more time to think about it, but here we are. The market's reacting as we speak. Where does this put in the context of what's going on in the economy, especially in light of the fact that this number has been revised quite a bit lately?
Well, look, Steve, I think this report has two or three complete elements in it that support different stories. I think the overall story the Fed will take from this is they have been right to push back on expectations of a quick pivot towards cutting rates. You know, the rate cut story of, starting in March and maybe 6 this year, I think this sort of knocks the legs out from that from the standpoint of the Fed. So I think you'll continue to hear some pushback there. And I think that's probably right. They'd also look at that 4.1 number and say, okay, things are still moving roughly in the right direction, but not moving as quickly as maybe some had thought. Point two, one that you've put your finger on just now, is, wait a minute, there have been some revisions. You've got to be really pretty careful here. We have been keeping monetary policy fairly restrictive. And so there will be some voices, Austin Goolsbee from Chicago comes to mind, that will be pointing to that as saying, let's be a little more cautious here. I think that's a slight contrarian point of view versus the majority point of view. All of that means that, you'll hear them continue to use words like cautious, too early to declare victory, preparing to move nimbly if need be. So I think this leaves them roughly where they were before, pushing back on the notion of mini rate cuts this year, starting early, but in no sense yet declaring victory on soft landing, because there's some things here that do suggest potentially, a hard landing might be ahead of them as well.
Roger, when the number came out, I focused on the private sector number. Is that the one you think that the Fed is maybe a little bit more focused on for what it says about the economy? We've had this surge in government hiring as government, it appears, is trying to catch up with where it was before the pandemic. Is that a better way to think about this number? And in light of that, don't you sort of come up with a less or a cooler job market than you would if you look at the top line number?
Well, look, I tend to look at the top line number, and here's why. The government is an important part of the economy overall, along with healthcare, along with tech, along with other things you talk about. It's a reflection of different kinds of supply and demand imbalances. Remember, one of the questions that is driving inflation is, well, how much fiscal stimulus is there put into the system? That gets reflected in the government number. So I would be a little cautious about saying, private sector number is where we should put most of our weight. The government is an important part of the economy, and it's a reflection of fiscal policy, and it's a reflection of a different kind of supply and demand. So I tend to look at both, but I would be a little cautious in saying, all weakness or more weakness in one versus other.
Yeah, I'm only saying that because local government just pretty much got up to the level it was at before the pandemic, so maybe some of that eases off. Let me turn to another issue that was brought up by Doug Holtz-Eakin, which is the idea of productivity. We've had fairly strong productivity. Is that another reason to look maybe less cautiously or be less alarmed by the wage growth numbers? If productivity is high, then wage growth should be higher.
No, I agree with that completely. But you also hear some of these anecdotal stories come into play. So, you're a Fed watcher, you know what the beige book is, which is basically all the anecdotes. And I think they're trying, and you hear them talk about supply and demand coming to better balance in the labor market. And so, yes, don't put too much weight on the 4.1 because productivity is an important part of that story. On the other hand, they're looking at the whole question of job openings. I think they may be a little concerned about the labor force participation rate pulling back, which means, the supply coming in may be a little more constrained. So again, I look at this and say, the cautions they've been talking about, the pushing back on let's cut quickly, all of that I think is validated by this report.
Roger, I've known you a long time, and you've been cautious that entire time that I've known you. Tell me just quickly, if you wouldn't mind, would you be cutting rates this year, and when and by how much?
I think I would be very much in a watch and see mode, prepared to cut rates if things look like they're getting too bumpy. You've heard me occasionally talk about a worry that I have about a hard landing being too quickly discounted. But right now, I'd be in the let's wait and see, probably rate cut in the second half of the year. So call me sort of in the meeting of the dot plots as they showed up most recently, but prepared to move more quickly if things look like they're falling.
But it would take a really rocky economy before you would say go ahead and cut sooner?
I think so, yes, Becky. Now, look, we have some concerns, and I've heard, I think Doug or others talk about what exactly is happening with the household sector. You know, are they running on fumes, so to speak? No evidence of that thus far, and unlikely with a strong labor market. There are some concerns about the business sector and business fixed investment. So there are places to look for softness, but right now I think the major theme is the economy's holding up pretty well, getting back into balance, and so far so good, and let's hold on to where we are with the discussion of rate cuts towards the end of the year, not the beginning of the year.